You were a bee's dick within getting Robe Mesa.
We shook on a deal where effectively I was saying, look, you know, you pegged this ground 20, 30 years ago with a view that eventually Rio were going to buy it off you. For some reason, they haven't bitten. You know, the miracle deal is tied up in FIRB. I think I want you as a large shareholder in Fenix, Mark. I think we'll be the right owner of this asset. We've got the skills to build it and deliver it. And I'll do a deal that gives you one last chance to show it to Rio. And so they came over the top of us. We were quite happy they did, because by bidding for it, it had actually sort of shaken the Baowu relationship or the Sinosteel relationship up. And we ended up very, very rapidly doing the deal, which made much more sense to us, which was securing the Weld Range project.
This is general advice and my opinions only. This episode's company has paid me for this interview. I may be long, short, or hold an interest in stocks or CFDs mentioned. Past performance isn't reliable. The interviewee's views are their own, not necessarily mine. LEVRD operates as a corporate authorised representative 00131 8377 under AFSL 548573. You can find our financial services guide via the LEVRD website, link in the show notes.
Johnny Welborn from Fenix, mate. How are you?
Great. Enjoying myself in an interesting market. Good to see a bit of sporting memorabilia part of the LEVRD outlook.
Oh, no, mate. You're happy to donate a Wallabies jersey to me if you want. I'll even put that up now that we've got a couple of league players over there. Mate, she's all happening. You're obviously aware of the war, the talks of diesel. You were actually, Fenix was, you were one of the first ones to sort of come out, and you had a bit of a, pardon the pun, a bit of a perfect storm, unfortunately, with the cyclone and the diesel and everything. And I actually, reading your announcement, I appreciate the no bullshit approach to, I guess, the disclosure on what was going on and guidance and everything. Mate, take us through what's happening on the operations at the moment. And I want to get into growth. I want to get into everything that's going on at Fenix. Give us the rundown.
So Fenix is an iron ore producer in the midwest of WA. So behind me is Geraldton Port. We're running at about 4.5 million tonnes of iron ore. And as you mentioned, we had the congruence of nasty cyclone Narelle bearing down on us at exactly the same time as we had the implications of fuel supply issues and other things. So we got out ahead of that. That announcement importantly reiterated our confidence in our annual guidance, which is to produce between 4.2 and 4.8 million tonnes a year of high quality iron ore. And so we're still on track for that. We did get thrown around a bit by the cyclone, the rainfall, the roads closing, the port of Geraldton closing, and the ongoing challenges of supply. But generally, the operations are going really well. We're running 3 small-scale iron ore mines. We have a mining business. We have a haulage business, carts that iron ore 500 kilometres through the Midwest to our facilities at the port of Geraldton, where we have a port business.
Yeah. Yeah. And like you were, like, well, last time, God, it wasn't long ago, you were just a boutique iron ore producer in the 1 million tonne range. Now you're pumping 4 million tonne out, which obviously triggered some performance milestones for Newhall that you acquired, and we'll get into that later. Are you going to be playing with the big boys soon?
Well, I think we're starting to become relevant. And you're right, for your punters who are out there chasing nickel stocks or antimony or tungsten or whatever's hot, they probably might have missed the Fenix story. It is unfortunately a rare example of a company that's done exactly what we set out it to do. So we got into production in 2020. That was based on a feasibility study in 2019 that said that for $15 million, we could build the Iron Ridge mine and get iron ore in a boat in Geraldton for 85 Australian dollars a tonne. We're now doing that for 75 Australian dollars. So 5 years later, production volumes have gone from 1.5 to now 4.5 million tonnes a year. And our ambition is to get to 10 million tonnes. So we're not with the majors yet, but at 10 million tonnes, and we're 3 to 4 years away from that, we become a lower cost, higher volume, much more significant iron ore player. And that's going to be significant for Fenix shareholders and the Midwest, WA and Australia.
Yeah, and because from where I'm looking, I want to look at, I'm just looking at your chart at the moment. You're obviously, it's sitting at 33.5 cents. It's pulled back a bit. And I'm like, okay, iron ore's you know, the 61% number's sitting at about what, $108 at the moment, CIF China. Yeah. And I want to understand, I guess, the sensitivity of Fenix to iron ore price, Aussie dollar, and fuel. And you've got, and you're the best man to explain it because you run the joint, is your hedging strategy behind all three of those, the dollar, the diesel, and the iron ore, and I guess what sensitivity and how you've actually performed in this period of higher diesel prices with that, I guess, 30% protection against the diesel price.
Good. So before we get into the complexity of hedging and diesel pricing, I'll take up your opportunity of actually explaining our business with some real clarity, because it's easy. I spoke about C1 cash costs earlier, and the whole bulk commodity market talks about C1 cash costs in the same way the gold industry talks about all-in sustaining costs, hoping that the investor public calculate a margin based on C1, which is actually not our business. So when C1 is all of the cash costs to get the iron ore out of the ground and get it in a boat, like the one sitting behind me. And in our business, very roughly, that's $25 to $30 mining, crushing and screening, $25 to $30 haulage, and then a similar number from port and other corporate costs to get to 75.
That Aussie dollars, John? Is that
yeah, Aussie dollars.
Aussie dollars,
so at this point, the iron ore is sitting in the boat behind me. Then we've got to pay the state government a royalty, which let's just round that out to $10, depending on the price, Aussie. And then we've got to get the iron ore all the way to our customer, which in the main iron ore market is based in China landed pricing. When you said $108, which is the index price today, that's landed in China. So it's going to cost us pre-war 30 odd Aussie dollars in shipping. Depending on the exchange rate, your $108 a ton, let's call that rounded out to 150 Aussie dollars a ton. And if you build up our C1 of 75, royalties of 10 and shipping of 30, you're at 115 Aussie dollars in China. The price today is around 150, 160 Aussie dollars for our products. And so we're making a $30 to $40 margin. And that's the business explained really simply.
Yep.
Now, we protect that margin given the volatility in iron ore prices and our exposure to exchange rates, as evidenced by that calculation, and more recently, our reassessment of our diesel price risk. And so we have a number of hedging strategies in place where we lock in the iron ore price in Aussie dollars out as far as we can. And more recently, we've looked to protect ourselves against a strengthening Australian dollar, which would erode that $30 to $40 margin. And even more recently, we've gone out into the forward market and bought terminal price diesel or oil to protect us against any long-term impacts on the war on what is a key cost driver for us. I mean, I think look, we tracked through 40 cents, 50 cents as we've expanded production, as we've demonstrated we can control our costs, and as the iron ore price is showing ongoing resilience above 100 US. And so I was looking forward to that continuing and us getting in the index and re-rating for a variety of factors, some of which we've discussed. We pulled back into the low 30s. So the market cap is around $250 million. I think that's a phenomenal opportunity for the upside exposure in iron ore. So put simply, at our current run rate of on its way to 5 million tonnes per annum, every $10 US change in the iron ore price represents 5 million times, let's call it $15. So you're talking $75 million of additional earnings.
Yeah. Okay.
Straight to the bottom line.
Yeah. Okay. So a lot of the protections you've got is if I know your call options you've got on the exchange rate are for 73 cents. So obviously you're protected if it goes past that. You're obviously, a lot of it's downside protection, but still got. Is there a ceiling on the iron ore price in your hedging strategy is what I'm asking?
No, not at all. We only hedge at the moment. We've probably got 20% of 12 months production hedged.
Yeah.
And it's really just, we don't see it as anything other than a timing issue. So that, when we started the business, we were enjoying high iron ore prices and we knew that they would be lower. So locking in high prices out into the future made sense. It still does in the business, but increasingly less so. The best hedge for a miner is to control your costs and be confident that you're going to have a margin in the product that you're producing at any prevailing price. So we don't see hedging as a mechanism to guarantee profitability. It's really just risk mitigation in an environment where we think the price might erode. Increasingly, I'm confident that the iron ore price is actually more risk to the upside than downside. And that's probably why our forward hedging has come down from it was 30%, it's now about 20%. It still makes sense to do. It allows us to sleep well at night. It keeps 300-400 staff confident that they're going to have a job not just in the next 6 months, but out into the future.
There's two sides to the iron ore price story, I guess. And I believe, and your comments in your investor call nailed it. Like the Simandou's producing, and analysts have got it baked in. It exists already, but then you hear some fundies saying, look, iron ore is going to be 110 to 115 forever. I want to hear your take on iron ore price, the effect of Simandou, taking into account the offset of the rubbish China produces, and I guess where you see it going. You wouldn't be doing your job if you didn't say it was going up. But what's the high level take going around the world?
Well, it's interesting you say that, Matty, because I haven't been arguing with long-term price forecasts historically. We run the business quite conservatively, and as you can hear, we're managing what if scenarios, and we've got a whole range of them. However, I am increasingly of the view that there is a structural bearishness in iron ore forecasters, and there's some really obvious reasons. If you looked at the modern economy like the US or particularly France, where I lived when I was a rugby player, and you analysed it in the same way that bulk commodity forecasters look at the market, you would say that the US dollar is going to collapse because their debt ceiling is going to be breached and there's no way that they're going to repay their debt. Same with the French economy. Obviously, people don't. They look at different factors as to how they look at the exchange rate formulas. Whereas with iron ore, people look at port stocks or forward demand or the seaborne iron ore market and forecast, as they have every year on year for the last 5, that there's going to be weakness in the iron ore price. And every year it confounds them by maintaining strength. Put it as more simply, if you're a believer in tungsten, copper, zinc, nickel, or any of the non-precious metals, you're effectively therefore saying that energy transition is going to need new materials, or war is going to drive a need for better steel reinforcing, or construction is going to, in parts, rebuilding. All of these things are, all of those commodities effectively are linked to and a derivative of the massive global steel engine. So you cannot be bullish copper and be forecasting weaker iron ore prices. So I think that the long-term outlook for iron ore is very strong. Only last month, the US government added iron ore to their list of strategic minerals. So if you're out there chasing an investment on where the world's going and what's happening next, and so therefore you're looking for an antimony stock, it's a lot simpler. Look for earnings, look for cash flow, and back strength in iron ore.
Yeah. Mate, before we get into your latest, you wouldn't even call it acquisition, your latest growth strategy with Weld Range. Let's go. I just want a quick take on, like, you were a bee's dick within getting Robe Mesa. Like that was and I'm sure that was unfortunate but an exciting journey that you went on with that potential acquisition. And once Rio get involved, far out, the firepower there. What happened? How close were you? And once Rio got involved, were you like, geez, we're stuffed here? What from inside the boardroom would you like to give?
Look, I think our strategy there was pretty obvious. I went up to see Mark Creasy. He was always going to be the kingmaker in that deal, along with Annie Gow. And we shook on a deal where effectively I was saying, look, you pegged this ground 20, 30 years ago with a view that eventually Rio were going to buy it off you. For some reason, they haven't bitten. The miracle deal is tied up in FIRB. I think I want you as a large shareholder in Fenix, Mark. I think we'll be the right owner of this asset. We've got the skills to build it and deliver it. And I'll do a deal that gives you one last chance to show it to Rio. And they'll have to either take it or not. So we were backing that Rio had plenty of time to look at this asset, and if it was strategically significant for them, they would have already bid for it when Miracle did and when it was tied up in FIRB, and they would have seen the same opportunity we saw. Now, what actually happened is that at the same time within Rio, they had realised that they needed to move a road. I think also in a post-Juukan Gorge environment, along with the whole industry, they're realising that greenfields development for them is very difficult, and incremental approval development is where they need to go. So acquiring the Robe Mesa project, which is a long strike from their Robe assets, was of renewed strategic interest, and so they came over the top of us. And at that point, we were quite happy they did, because by bidding for it, it had actually sort of shaken the Baowu relationship or the Sinosteel relationship up. And we ended up very, very rapidly doing the deal, which made much more sense to us, which was securing the Weld Range project. So step back a bit to answer your question about why we were chasing it. We had a very small postage charge envelope. I spoke about the history of getting Iron Ridge into production. It's a 10 million tonne ore body. It's constrained by heritage. Although we've got more material there, it's more expensive to get to. And so we were desperately looking for, where's our future? Where can we apply the skills we've got? I still think the CZR project would have been a very, very good match for those skills. But an even better match, and a more obvious one, is the 300 million tonnes that are existing in and around our existing operations. So we went after CZR. It was a genuine bid. It was, it would have been great to have Mark on board as a shareholder. But what we've now got is much better.
Yeah. Was that the backup plan the whole time, or was part of the strategy? Well, if Rio come in, that's going to open up Weld Range?
Yeah, I think the strategy with going after Robe Mesa wasn't to back away from the Weld Range. It was, the management team, the board, decided we could do both. Can we continue to work on the Weld Range, and can we also develop a similar operation further north? And we were comfortable that we could. And that was quite ambitious. I'm really, our focus though has changed, Matty. You saw us doing lots of outward things. We looked at other projects, most obviously the ones that people would be aware of, MinRes's Yilgarn operations, unsurprisingly the Red Hawk opportunity, which again was taken by the obvious buyer, which is the next door project being FMG. The great news for us is we're in blue ocean space in the Midwest. Iron ore was discovered in this part of the world in 1870, and with the exception of Mount Gibson's 50 million tonnes, the other remaining billions of tonnes, no one's extracting. So we're actually delighted to have been successful. We were looking for a major project or major projects to focus our execution skills on. We've now got that, and now the entire team, as evidenced by our scoping study published in December, is focused on delivery, and our pathway is really clear.
Yeah. I'll tell you, Fenix at the moment, I'd say you're the complete opposite of Fortescue in the early days in terms of the leverage of the business. Like Fortescue had $16 billion in debt at one stage. And this takes me to the Weld Range setup, which is going to, it's touted to take you from 4 to a 10 million tonne producer. But you haven't got, it's a royalty-based and profit share setup, and it's a right to mine. You don't own the asset, you've got the right to mine.
But I can't miss the opportunity you've given me to, I don't know if anyone noticed, Natty, surely you noticed my piss take of Andrew on the new Western Force in Iron Ore. So the era of of FMG when they were in a, if I can say it's a similar position, obviously, when they were a hopeful, when they were a junior, the slogan for FMG was the new force in iron ore, and they were unashamedly taking on BHP and Rio. So obviously, as a former Western Force player, and Andrew Forrest is the current owner, it's been fun to have on our, I hope other people have noticed that our slogan is the new Western Force in iron ore. But you're right. I don't think, our ambitions are no less dramatic than Andrew's and FMG's. I do think we can change the landscape of Western Australian iron ore, and particularly the Midwest, in the fullness of time. And we might get to that when we talk about the energy transition, magnetite, Jack Hills, and our Baowu relationship. But the big difference that you've identified is significant for investors to think about, which is FMG went big. They were going to take on Rio and BHP, and they raised an enormous amount of debt and built a huge project from scratch. We believe at Fenix we can build a similar scale project. However, the pathway there is completely different. Incremental development. We raised $15 million. The last time we raised equity, it wasn't hundreds of millions, it wasn't billions, it was $15 million in 2020. We haven't raised a ZAC since. We've invested $300 million in the project by building production capacity and using net cash flow to reinvest in infrastructure. So our pathway to being 10 million tonnes a year and more is to do 1.5, then to do 3, now to do 5, and then you'll see us do 10, and generate the right and the confidence of the market to invest more in incremental build. Now, the right to mine, I call it synthetic ownership. So Sinosteel and their forerunners have invested billions of dollars in exploration in the portfolio that we now control. Sinosteel amalgamated a range of companies, did a major exploration project, and as a state-owned Chinese enterprise, now acquired by Baosteel, the world's largest steel maker. We've been able to do a deal with them, which is a 30-year exclusive license, a right to mine. They're very common structure in the mining industry. And it gives us complete control over the mining operations, the scale, the investment, the capital. And in return for that, we pay them a $4 a tonne Australian dollar fixed royalty and what will be a 15% share of the net profit after tax of that operation. And we paid them $60 million in milestone payments with several milestones still to pay. So I think that's a cracking deal. If you look at the value invested in defining those resources, these are high-grade direct shipping or iron ore resources in and around our existing infrastructure. Compare that to the Red Hawk acquisition, compare that to the CZR acquisition, or any iron ore portfolio of similar scale, and it's an absolutely cracking deal. On its financial metrics, I think one of the aspects that a couple of quick comments about what hasn't been appreciated is the offtake arrangements, which give effectively a right to match, so we can continue to market our own iron ore and get full price transparency. The other key aspect is the partnership that it effectively creates with the world's largest steelmaker. This is an entity that is ultimately responsible for the development of Simandou that you mentioned earlier. This is someone that Fenix is very proud to have in our corner, supporting our development. Andrew and Fortescue, as you mentioned, were supported by incredible support from the bond markets, but it came at a price. We have support of the world's largest steelmaker. Their support is based on the fact that they want our product. It is essential for their industrial engine, and that's a huge strategic benefit.
Yeah, it's okay. So if you're up in the tons, we're getting up to 10 million tonne, but for that, delta of 6 million tonne, as you said, you've got the royalty to consider the profit share, but you've got milestone payments. So like you'd say you've synthetically acquired the asset pretty cheap, but considering what you've got to give away, offset by the increase of tons and efficiency, like what is there? Is it a similar margin we can expect in the future, or better margin because of more tons, considering what you've got to give away for that margin? What's the insight there?
So look, I don't think a $4 Australian dollar royalty a tonne is a bigger bite as you're implying. If you look at, similar small companies, when they're getting projects into development, often have to give away a royalty or take on what ultimately looks like very punitive financing. And again, to continue the example of FMG, it almost killed the company. And then, we're very cognizant of experiences like Atlas, which is now making billions of dollars for Gina and Hancock, but didn't reward its shareholders. And we are unashamedly about rewarding our shareholders. So the structure, I think, is very value creative for shareholders. It's a manageable royalty. And the answer on margin is it gives us a pathway, as identified by the scoping study, to have a C1 cash cost in the 50s. And so therefore that equates to a break-even iron ore price in the 60s, US dollars per tonne, CFR China. And so I think in the years to come, an Australian dollar, $4 a tonne royalty is going to be seen as an insignificant impost on the value of our operation. I think it's easily manageable.
Yeah. What about the profit share side? But how much dollar a tonne attributes
to that?
Well, look,
that's a bit harder to work out because obviously it's a net profit after share. So we include depreciation, tax. Flip that around. Effectively, 85% of the profit of this operation in what was originally configured, if you look at the deals, it will be to Fenix's benefit. Most of the deals Baowu have done similar deals with majors, Rio Tinto, Minres as probably the smallest company, and other, Chinalco in Africa. And usually they're based on 50-50 joint ventures or 60-40. This has the flavour of a 50-50 joint venture, except we're getting 85% of the benefit. I think that's the way to see it. We have control of the cash flows. We pay what I think is a relatively manageable fixed royalty, which is an easy thing to calculate, and then we get 85% of the net profit after tax.
Yeah, and so I'd assume there'll be a bit of capital allocated towards the hedging towards those extra tons. Is that going to be a thing that's going to continue in the business to protect yourself going forward?
Yes. Look, there is some other protections. That 15% net profit after tax is only at prevailing on our iron ore price of $100 a tonne. If it's below $100 a tonne, it drops to 10%. So that's the sort of protection that we look for, and that you're right that we will continue to have that policy when we look at risks to the business, exchange rates, diesel price, iron ore price. It's an opportunistic approach to where we can lock in a positive margin. We will do so. Yeah,
and look, trucking is it's not just the trucking on site, like the trucking to port is one of your a big part of your business, and probably one of the most sensitive parts of the business. And you're in-house now after acquiring Newhaul, 60 million shares, which all milestone payments have been completed for that. So what is that? Just take us through what that's brought to the business, and I guess having that in-house now, are you a bit more safer on efficiencies and control over such a sensitive part of your business?
Yes, is the short answer. Bulk commodity businesses are always about logistics. We're not really a mining business. I said earlier, we've got a mining business, we've got a haulage business, we've got a port business. Being able to control all of those and manage the, in some cases, competing interests within them is absolutely fundamental to Fenix's existing success and our future success. Unusually for an iron ore miner as well, currently 100% of our tonnes are on road. So we're hauling iron ore 500 kilometres from the Weld Range all the way to Geraldton. And being able to do that, the efficiency we do is entirely the response of the skills in our haulage business. I referred earlier to the feasibility study completed in 2019. Again, in rough numbers, it was basically $25 mining, crushing and screening, $50 road haulage and $10 at the port for an $85 C1 cash number. So that tells you that we envisaged that haulage was going to be the biggest part of the business, roughly $50 a tonne. Now we're doing that for less than 30. because we own and control that business. We're really efficient. We've got a lot of technology in it, and we manage it very, very closely. And it's not a contractor relationship. Where we need to flex, we do. Where we need to scale down, we do. And we have the flexibility and control of an owner and an operator.
Yeah, and I guess from that acquisition, one of your major shareholders now, Craig Mitchell, owner of Newhaul, when it was on the board, stepped off the board, has been obviously part of the integration of Newhaul into Fenix. Sold some shares recently because he was paid in shares, 60 million shares for the business. I'd be wanting to take a bit off the table and buy a house as well. He's sold 10 million shares, off-market trade at 3 million, but still owns roughly 11% of the company. So I guess as a major shareholder, said in the quarterly that he's going to continue to be a supportive shareholder after he stepped off the board. I guess, can we, any comments around, I know you can't say if he's going to future sell or not, but his involvement in the business as a major shareholder going forward?
Well, the first thing to say is how influential and important Craig Mitchell has been in the Fenix story for the reasons I just outlined in terms of the importance of our haulage business, which was founded by Craig and built by Craig. And my journey with Fenix has been very much around meeting Craig and from the outside looking at the company's plans. And then actually seeing the difference, the skills that the haulage business has brought to the entire company. And the success of Fenix has been very much around what was originally a joint venture with Craig's private company. It's now 3 years ago that Fenix acquired that, and unsurprisingly, we've now paid the last successful milestone, which when we did that deal might have seemed outlandish to some observers. We didn't have 10 million tonnes to haul, and the last milestone required 10 million tonnes of haulage. So it's been a very successful business. It's been a very successful partnership between Fenix and Newhaul and between Craig and myself. And you're right, it's actually 90 million shares if you include the upfront acquisition cost.
Yeah.
And so over that journey, Craig hasn't traded a single share. The recent trade, I understand, was an off-market trade to a family group within the Mitchell family. And Craig has indicated he's a supporter of the business. As you point out, I wouldn't be surprised if he's managing his own portfolio investments, and the decision on whether he's a long-term holder or not, and how many of his shares he's holding for the long term is ultimately up to him. What I do know is that he is a strong believer in the strength of our business. Like me, he traded off salary for long-term equity reward, priced at much higher share prices than we're currently seeing for Fenix. So that would indicate that he, like me, is a believer that Fenix will be $1 a share per share or more in the future as we execute on our development plans. And he remains today the largest individual shareholder in the company.
Very good, mate. Thanks for being open about that. The other strategic stakes, APAC and Mount Gibson, just passive, strategic. How are they involved in the business?
Well, so obviously, in a similar way, Craig Mitchell is a shareholder because we acquired his haulage company, or the joint venture, the 50% of the joint venture we didn't own, and then the entire Newhaul business and all of its IP. And Mount Gibson are a shareholder because we acquired two of the three sheds we own at Geraldton Port that you can see behind me off them. And also the Shine Iron Ore mine, and also the 2 rail sidings that they owned and developed, and a whole range of other assets. So Mount Gibson are the most successful miner in the Midwest prior to Fenix. They invested hundreds of millions of dollars in that infrastructure, and we effectively acquired it for what is now an 8% or so shareholding in the company. And in both cases, I think it evidences their support for the development potential of Fenix, that they're long-term holders in the company. My relationship with APAC goes back a lot further to attempting to build iron ore mines in Africa 20 years ago, and APAC's successful support of companies that I was involved in. So I think For Mount Gibson, it's a legacy investment in their Midwest business. They've obviously changed focus. For APAC, I think the driver of that investment is exactly the same reason why they've been, a decade-long or longer investor in Mount Gibson when it was an iron ore company. They're a Hong Kong-based trader, very familiar with iron ore markets. And I'm very confident that they see the long-term value in our development plans.
Your 37% stake in Athena, magnetite, I think it's 29.5% iron grade magnetite. What's anything going on there? And without knowing anything about magnetite, people look at it thinking 29.5%, that's bloody crap. But magnetite's a bit different to the higher grade stuff and can be upblended. What's going on with that position?
So the percentage to look at isn't the in situ, it's the product quality. So Athena and the pyromagnetite project is very unusual in that it, at a very coarse grind size, which is all about cost and the energy you need to put into it, it can produce a 70% magnetite concentrate. And I'll try and tell the story quickly, but if you've been following Fenix for a while, you'll know that there was a time when we had available capacity at the port that we weren't using, and we were looking for third-party customers, and we were looking for other opportunities, and we scoured the Midwest for potential opportunities, and we're looking for exciting things like tungsten or talc, silica sands, potash, vanadium, and there are hundreds of projects in development. One that kept on popping up was Athena, but at the time, picking up some of the perhaps skepticism in your question, we weren't focused on magnetite. And to hark back to the answer about the Mount Gibson, one of the things we picked up was rights over Extension Hill, which we didn't effectively exercise as a magnetite project. What we see in the market, we market hematite iron ores, and we're very confident in the long-term installed infrastructure, which is blast furnaces all over the world that's going to need those products. However, there's no doubt that we're also now believers in the adoption of cleaner steel technologies, what is called in many cases green steel. The development of that technology, which is going to take decades, is going to ultimately require high-grade magnetite concentrates. So we do see a time where there is going to be a very high premium in that product. And we also see that the Midwest, with its abundant resources of magnetite, its wind and solar potential, and the fact it has two gas lines passing through it, most importantly, that we're building a business that we're confident is going to run for decades, means that we should have some exposure into that. So for a couple of $1 million, we've got roughly 40% of what we believe is the best magnetite project in the region. It's a separate company. It's run by its own management team. We're going to back them. They're doing great stuff. They've already reinvigorated that project. They're looking for a pathway like Fenix, that incremental story I thought about earlier. All the magnetite projects in the world are like FMG. Let's raise $2, $3, $4 billion, build a 40 million tonne a year magnetic separator and go huge. And many of them have been challenged because of that scale. Athena is an Iron Ridge type opportunity. Let's start small. Let's do 1 million tonnes a year. Let's use Terra's skills of being the only successful magnetite miner in the Midwest. Let's use Fenix's logistics skills and get into production over the next couple of years. I think it's one to watch. It's 0.5 of a cent. If you've got your punters who are listening in and looking for something, have a look at Athena. Fenix is backing it. We're supporting the management team. We think it's got legs.
Yeah, interesting. Mate, when you're you're having interviews like this and trying to get people to buy your stock, what comps have you got? I always love a comp that you've got that Fenix versus someone else on a valuation basis. I'd love to hear it. This is your opportunity. So I'm going to share my screen in a minute. I may buy. This is going to be the first time you're going to have an interview and someone buy your stock live.
Good on you. So look, if you go back a few years, there were lots: BC Iron, Atlas, Jindalby, Murchison. The reality is that you have to look hard. People have compared us. You've compared us to FMG. Great.
Yeah.
They're a different scale now. You have to go back in time to use that comparison. The only really pure play iron ore stocks around there are Champion Iron, different type of company in North America. And then you've got a whole range of little players. So I'm not so sure there is direct comparisons. to Fenix as an iron ore producer and a pure play iron ore miner. I think I'd be delighted if you can find one. I think that might be one of the challenges as to why our market cap's still only $250 million.
Yeah, no, because I guess I'm looking at it the lens of like, are you trying to go a different route to get big on lower risk, or do you think because you're not levered up like a Fort, you're never going to be levered up like a Fortescue did, and you're like, okay, we're happy to take a lower risk approach to get big enough without getting too big by introducing a shitload of debt to do it?
Well, look, the scoping study has roughly $500 million of capital, and I think we identified that we thought we could generate 200 of that over the time frame we're going to need to invest it, which leaves you with a $300 million gap, which unfortunately is higher than our market cap. So you get into that issue about, well, great scoping study, but are they going to be able to fund it? I think if you look at our revenues and you look at the relationships we're building, we don't believe we're going to have a funding problem with, and also the dynamics, the NPV of just the scoping study at spot prices when we announced it is 3 billion Australian dollars. It's a very, very fundable project. Yeah. So there is a viable pathway to Fenix having that scale of investment without ever needing to raise equity ever again. And so that's very exciting. There's not that many. I think, again, it's very hard to find a peer company that has the upside exposure, the track record of execution. We are a dividend-paying, profitable company with unbelievable growth potential. I see it as an asymmetric investment. The upside's really obvious. Just dial into one of my webinars or this conversation. But let's talk the downside for a moment. The sheds behind me have got an insured replacement value of 200 million Australian dollars. I ran through some of the infrastructure assets we own, rails. This is without the iron ore value. We've got $150 million in rolling stock. This is trucks and trailers. We've built a $30 million industrial depot on the outskirts of Geraldton. We're building a $20 million housing subdivision for the 300 workers we've generated, the jobs we've generated. There are a lot of hard assets in the business that flow through. And then I think if you look at FMG, probably they're valued as a dividend yield stock. So if you back us to build the feasibility study that we're working on and the pathway to 10 million tonnes, dial in the iron ore price you think there's going to be. Fenix pays you a big, healthy, fat, fully franked dividend for a long, long time to come. That's why I'm looking to own as much of the stock as I can. You mentioned I've bought a few recently. I've got a strong incentive to build the company and continue to build its share price. And I'd encourage other people to look at that ownership outlook without perhaps the benefit, Matty, of having a really obvious peer.
Yeah, interesting, mate. Well, all right, I've done me DD. I'll hold on. I'll just share my screen here.
Yeah, buy, sell, 34. That's an absolute bargain.
There we go. Righto.
It's got to be the first time. You're right. It's the first time I've done a webinar. And someone's got on the screen. Well, congratulations.
Well, I'll chuck it. It was bloody 33.5 not long ago, and I bloody missed the boat. So I'm giving away a pip for you. I can only get 10 worth. Righto. I'm in. There you go. Deal confirmed, Johnny.
Good on you. Welcome.
All right, I'll have a little tickle. If I get bloody margin called next week, I'll tell you what, we'll bloody see what you like at tackling. If you still got it.
That's great news, Matty. It is frustrating to see that sort of recent red on the screen, though. I do want to get back to the green that you can see on that graph, and I think there's. We're cranking at Fenix. We've confirmed our guidance in the face of cyclones and famines and fuel crises and everything else. And we're myself and the rest of the team are now working very hard for you, mate.
Well, very good, mate. There you go. You're now in the levered fund, and I'm like, well, I'm not going to buy it without talking to the main man himself. Ain't a little tickle so far, mate. But mate, thanks so much for coming on. I've had a bloody. This has been a ripper. So, and mate, best of luck to always wish everyone in the industry best of luck and safety and everything for building the project and scaling up, mate. So it looks like all the work's getting done.
Thanks for the opportunity to have a chat, Matty, and welcome as a shareholder. Good on you.
It's as a CFD, so it's like, I won't be on the register. It'll come up as IG. Thanks, mate.
No worries. Cheers. Bye.